Hi, welcome to the Funding Blueprint, Unlocking Startup Success, presented by StartHub. I'm Cody Goff, and today you're going to learn what investors look for in early stage startups versus later, more established startups, including the numbers that they look at, even when limited data is available in terms of company performance. Plus, my guest has a hot take on why a founder should raise for what they need now and not what they think they're going to need later. Charles Greszes is an investor at And Ventures, an Israeli venture capital firm investing in pioneering early-stage startups and building them into companies that make a difference. They recently closed their first fund at $70 million, assets under management, derived from US-based VC fund managers, private equity and hedge fund managers, and other key LPs representing numerous industries spanning across the globe. And can take a company from incorporation to IPO through 3 investment arms: And Studio, And VC, and Beyond. Charles Greszes is an investor at And Ventures and is based in Tel Aviv. I started by asking him, what's the coolest startup you've worked with and what made that startup so impressive that you wanted to invest? Here's our conversation.
Awesome. First off, thank you for having me. And I think the coolest startup that I've seen, it's actually one of our portfolio companies. It's called Unibeam. And what they do is they offer a new way to verify your identity on your mobile device. So if you think nowadays, you currently have 2FA, so two-factor authentication. So you get like a message on your phone, you put in the code, and it works that way. But as I learned, kind of going through the DD with them and through the investment process, is it's very susceptible to like hacking. And it's very easy to hack it and hack your phones, and it's a horrible current solution. And instead of that, the solution that Unibeam provided is they take they link the codes of your phone, your mobile number, your SIM card, and they link it all together to create a special code. And it happens to be more secure and more private. And like the main factor here is that they involve the SIM card. So it doesn't matter if you take out your SIM card, you put it in, they can track every place that SIM card is. And it happened to be, just to me, it was definitely very interesting. I've never seen anything like it in the market. And it's kind of what caught my eye and what really impressed me is the founder's passion, love, and devotion for what he's building. I remember one of the first conversations I had with the founder, I asked him, what made you get into this market? Because it's so niche. And he told me that there are jobs that people have where they like regret being in their jobs, or they dread going to the office, and they rather be with their friends. They rather be doing one of their hobbies. For example, I play ice hockey, so sometimes people might want to play ice hockey. And for him, he told me when he's building Unibeam, when he's building his company, he'd rather be doing that than being with his friends, rather than doing any other hobbies. Building his company, his passion and his love for his own company it really impressed me because it showed to me, his strong motivation and also the resilience he would have as a founder.
You know, a lot of the guests I've had on this podcast have talked so much about the importance of the founder being really interesting and interested in their product. Some of the sort of the passion that you just talked about, but it sounds like you're also really into the product, which I don't actually hear as much when I talk to investors. In this particular case, or most cases, do you really get hooked by that product at first and you're like, oh, that's interesting. Now let's see what the founder is like. Or is it vice versa? Or does it just kind of depend? What do you think about all that?
It's a great question. I think it depends a lot, especially with early stage investing. A lot of times I say in early stage, you're really betting on the founders, because if it's a strong founder, I like to say they're experienced, they know the market well, and they're resilient, meaning they can pivot if needed. Because a lot of times in early stage investing in early stage companies, you have to pivot at least once. So I like to say it's mainly is the founders, but if it happens to be like a company that does, like I do like specific industries, for example, one of them being fintech, and just if I'm drawn towards a specific industry, I may like the product itself. And from there, I like to say it's not really the product, it's more of the tech moat or their competitive advantage. So for example, in this case, there's no one else besides Unibeam that is using the SIM card or the eSIM. So I hope that answers the question.
Yeah, it absolutely answers the question. When you're assessing a startup, what do you tend to focus on first and foremost? And is it different across fintech and other types of investments, or is it roughly the same?
So it's often the same for me specifically. And I already touched on it a little bit. I think the two main things that jump out to me on the first initial call is the team and that competitive advantage. As we were saying before, specifically with early stage startups, the team happens to be one of the most important parts. So getting to know the founders, I like that when I'm on the call with the founders, I like to have all the founders on the call initially, if they can be, just so I can meet the CEO, the person behind the tech. It doesn't matter where they are in the company. I think that each one of them should have their own strengths, because a lot of times, I think what makes a good company, a good team, is when the founders aren't the same, when they complete each other. So, for example, it may seem very obvious, but when you have the CEO, there are times where the CEO is very technical, and obviously he can also do on other parts in the company. But specifically for me, I like to see a CTO who's very technical, who has knowledge in the industry, where he complements the CEO, who's more of the business marketing and kind of the vision behind it all.
You've mentioned that it's particularly important for early stage startups a couple times. Why is it less important as you get later on? Is it just because it's like hard to assess because the teams are bigger? Talk me through that.
So the reason I say it's more important for early stage is when the company gets bigger and you go later out into rounds, so series, let's say B, C, and beyond, there's definitely a lot more numbers and financials that you can look at. For example, in early stage company building and investing, we're looking to bring a company from zero revenue, even pre-product, to get their first clients. So you can't even look at financials, and you can think, okay, you understand the market, but we really don't know how we can impact the market yet as a company. Versus in later stage investing, you have all those financials, and you're not taking a company from 0 to 1. You're taking that company from 1 million revenue to 10 million and beyond.
Got it. So it's essentially, at first, all you really have to go off of is the team, because they're not making money yet. Maybe they don't even have a product yet. You just got to kind of believe in their drive, and then later you have actual numbers that you can kind of dive into. In the early stage though, there still are some numbers, right? There's the total addressable market, cash flow in and out, the business plan and stuff like that. But that's not enough. It's for whatever reason, you also have to believe that the founder is going to be able to make that vision happen early on. But you do still look at the numbers on the earlier side, right?
Of course. We like to even validate the market. So for example, Ant Ventures, we're sector agnostic. So we're not necessarily experts in certain industries. And in order for us to know that there is a market, obviously on most decks, if not all of them, they have their total addressable market. And you can see, okay, it's billions of dollars typically. And for us, just looking at the numbers, obviously there's proof behind it. But during our due diligence process, we actually have kind of validation to prove that there is a need in the market and the market is big enough.
Yeah. I would love to drill deep and specific into what due diligence looks like. So talk me through the nitty gritty, just the very specific. What are you analyzing specifically? What does a day look like for you when a new startup comes across your desk? And what are the specific things you look for and the red flags that you keep an eye out for?
So I think Ant Ventures, we have a very unique approach to due diligence. We have a network of growth partners who are considered experts in their field. So, for example, if it is fintech, since I used the example before, it could be someone who's been working at JP Morgan for 25 plus years. So he has a ton of experience in that field. Or it could be marketing, it could be ed tech, whatever it is, it's an expert in that field. And part of our due diligence process is we set up 2 to 3, maybe more, depending on how complex the idea is and how complex the market is. So we set up 2 to 3 calls with these experts, our growth partners. Ideally, on this call, I like to say I'm the fly in the wall. It's really just the founders talking to this expert, and they're going back and forth. They're walking through the deck, they're walking through the plan, the vision, what they're currently doing. And the outcome of this could be one of two folds. It could be after the call, the growth partner comes back to me saying, hey, they're amazing. I'd love to be there on their advisory board. I'd love to use them, like meaning the company gets a potential client. Or the second half of this could be the partner comes back to me and he says, hey, it's an interesting idea, but it's more of a feature and not a product. Or the market's not big enough. And he really validates for us from his own expertise. And part of this, like I mentioned, with the growth partners, there are times, say one wants to be an advisor, he is interested. The next meeting could be someone he connects us to who is really would be a potential client. A lot on my initial calls, a lot of times I ask who's like your ideal client, and that helps in the due diligence process because we're able to put those potential clients in front of them and almost see if they can sell on that call, if they can prove their point, if they can get their idea across on that first hour. And it really shows, obviously the team, that they're experts themselves, and also that their idea, the product, is needed. I think a few of the red flags that could come up is really, like I mentioned, if a growth partner comes back to me and says, hey, we're not going to use them, like there's no need, like we already have X, Y, and Z that does that, meaning like the competitive landscape is way too big. That's one thing that would be definitely a red flag. Another one is it's not a need, but it's a nice to have. I think those would be the two main red flags that come up a lot of times.
That is a great answer. So I think you touched on it when you mentioned maybe the expert would say like, oh, I want to be on their advisory board. But what is in it for the expert generally? What do they get out of this relationship?
So our growth partners, they get a lot out of it, in my opinion. For one, we do have kind of like our network is all together. So our own growth partners know each other and they can almost like piggyback off of each other. So one fintech expert may need help from another one and they're able to connect that way. But specifically from our calls, what our growth partners get is that advisory board, meaning if they see a company that they like and they want to help build, they're able to be like, hey, I'd love to be an advisor. I can make the connection. If it works out, then they can be an advisor. Another thing is if they would use the product, it could be something where they're a growth partner and they would use it and then it helps their own company and helps, for example, it could save them money, could save them time.
That does sound like a win-win, right? You can either get on the advisory board, maybe get some equity from the company, or even just use that product. If I'm in an industry that needs mobile identity verification, and maybe I get introduced to Unibeam, all of a sudden I've got a really cool product, and maybe I can beta test it, get in at the ground floor. That does sound really good. And you mentioned that's kind of unique to And Ventures. Any sense of whether any other companies are taking this kind of approach, or how And Ventures, I guess, came to the conclusion this was a good idea?
So I know that this due diligence process, it's different at each firm, but specifically for us, how we came up with the idea, one of our managing partners, Roy Guyva Glassberg, he built Google for Startups, which is one of the largest accelerator programs in the world. And he built a network of Google experts to help those portfolio companies. And he saw the success there. And when he built And Ventures, I like to say he fixed a few things in the accelerator model with our studio. But on top of that, when he brought the growth partners, he saw the success at Google and he just brought it to And it's been working for us. And talking about other firms, I can't attest to other firms. I haven't worked at other one other than And Ventures, but I do know that there are platforms where it's a need for investors to have that market validation. So there are platforms we can go on. Obviously, you have to pay, but I believe they have all like recorded phone calls between CEOs and clients or potential users.
Yeah. After one of your experts gets on this call with you and with the potential startup, they ask some questions, they look at it, they call you up, they say, that was a great meeting. I think their product is great. I feel good about it. Is there still another layer of analysis that you need to do into their financials? Because an expert may ask questions from their perspective of the industry, right? But then you as a investor may have different questions in terms of like the viability of the business model, right? Or something like that. So talk to me about how much happens after those experts chime in.
So The way that I like to explain it is we have two managing partners. I mentioned Roy earlier. I like to call him the company builder. And then our next partner, her name is Lee. And she's more focused on the funding, the financials, and kind of like building your rounds. So after we do a due diligence process, typically before that, Roy has the initial call after like my call. Then we go into due diligence. After that is a meeting with Lee. And that's when it kind of gets into the nitty gritty between the financials. Through her experience, she's able to read the plan, see kind of how much funding they need now versus how much they will need, build a round specific for like valuation, how much they need, all that in terms of equity, and really having an idea of, from their projections, how much of it is really accurate and how much is more of a guessing game.
Okay. I've said about this podcast, a lot of times we talk about like the specific moment where a startup gets funded, but I think maybe what's gotten lost in that messaging that you've kind of flagged is, if I'm a startup founder, I shouldn't think, oh, I'm going to walk in and do my pitch like I'm on Shark Tank, and then I walk out and I'm kind of done. Like, it sounds like there are several touch points and there's a lot of communication back and forth. And so the pitch is not, I walk into a meeting, do a 30-minute PowerPoint, and now I'm pitched. It's an ongoing conversation with investors. What kind of a length of process is the pitch when they're working with you? Like month, weeks? What does that timeline look like?
So we have, as I mentioned earlier, or as you mentioned, we have 3 arms at AND. Within our studio, we actually just launched a new initiative called 230. So the goal of the studio is to provide funding up to $200K for that startup within 30 days. So we like to say the whole process for a studio company should take 30 days. That's from the initial call to the term sheet. Within the fund, I'd say the fund takes more of 2 to 3 months, just because there's more to examine, because typically for our fund companies, there are more financials. They're either making revenue or they have a product, they have users and potential clients. So that, I would say, is more 2 to 3 months. And that's kind of the difference we have, the 1 month in the studio versus the 2 to 3 in the fund.
I would like to drill a little bit more into the different parts of AND, which, by the way, we've been saying AND Ventures. You could also call it A&D Ventures. It's capital A, lowercase n, capital D. There's A&D or AND Studio, AND VC, and Beyond. Would you like to talk about what does the A&D mean, and then what those 3 different kind of like investment arms are focused on?
So A&D means accelerate and develop. It's part of our thesis here at and part of our goals is, like I mentioned earlier, we view ourselves as company builders, and then investors is like the next part. We focus on building the companies and having the future for the companies. As it's for the 3 arms of AND Ventures, our studio, it's similar to an accelerator or incubator with small changes. So for example, in the studio, we like to say it's our pre-seed model, where we take in all the pre-seed companies. Unlike an accelerator, we don't have cohorts. So we don't take in 10, we don't take in 20. And unlike an accelerator, we don't have a graduation date. So meaning, we like to take in one company at a time in our studio because it's a very tailor-made process for that company. And there's no graduation date because our goal in the studio is to help them raise the next round. So after we provide the initial funding, the graduation of the studio is the next round. So that could be 2 weeks, it could be 6 months, it could be 9 months. And there's an ongoing support no matter what, that we're helping them, we're building them, because we have an in-house team of a CTO, CFO, product, business development, and marketing. So we can build out tech, advisory board, and go-to-market strategies within the studio. As the second part of AND with our fund, it's more of our fund model is seed extension, where we do check sizes 1 to 3 million. Again, we're sector agnostic, but those are typically the larger companies that already have revenue. And the third arm, the growth arm, as I like to call it, is and beyond, where obviously it's more growth. Personally, I do less with beyond than with the early stage, but the model there is we're looking for companies already making 10 million plus in revenue, who have pre-money valuations of 50 million plus, and have a clear exit horizon in 3 to 5 years. So we like to say, as you said in the beginning, we could take a company from their initial idea until IPO, because we can cover building the company, providing the funding in the middle, and then helping them gain that IPO at the end.
So zeroing in on the early stage to even maybe Series B or C, is there a specific tactic that you see a lot of founders overlook? Something that they walk into a meeting and you're like, another one just isn't giving me this one thing that they need to do.
So I think it's less about what they're doing and what they're asking for. There are a lot of times where I think founders are asking almost for too much. Typically, it could be a hot take, but I think raising smaller rounds at specific times may be more beneficial for the companies, especially in the early stage. I like to say raising for what you need now, for two main reasons. For one, it's a better valuation control, because if I'm an early stage company and I'm raising $5 million pre-seed or $3 million pre-seed, I'll be giving up a lot more of my company. And if I start raising, for example, like in our studio model, raising a smaller round, it may be harder to comprehend, because a lot of times founders are like, okay, if I raise money, I can have money for the next 2 years and I won't have to raise again. Versus if I raise a smaller round, I'll be able to keep more ownership, and also I'll be more focused on milestone achievement. Meaning in a smaller round, you can have specific milestones or goals, such as product development. So when you finish like building the product, you can raise again, or market validation, or even like customer acquisition. When you have a smaller round, the next round, if I can acquire my first five customers and already have revenue going into my next round, I'll be able to raise more. I'll have a higher valuation, and it just will be better all around for the team.
I love hot takes, so I'm glad that you just flagged it as that. So as an investor, that doesn't bother you if a startup you're working with says, we want a little bit now, and then a couple months later, we're going to do a little bit now. That's okay to do. Because maybe do you think it's because there's a feeling among startup founders that like, all right, I've got their attention, they're really busy, I don't want to bother them, right? Like, let's just ask for a bunch of money, and then we can go away for 6 months, do our thing, and then we'll come back. Where do you think that comes from?
So I definitely think it comes from that that they're almost. I get it. They're almost scared that they won't be able to get the funding when they need it. And obviously, like, a founder shouldn't come to a VC when they're on like their last legs. When they have like 1 month runway or even less than a month runway, you shouldn't be coming to a VC being like, "Hey, we need it now." Just because, in my opinion, the process itself can take more than that 1 month. So it may be hard to inject that cash as soon as you need it. So I like to say that when you raise the round, you should raise with keeping in mind almost like 18-month runway. So when you raise that first, you should have enough money for 18 months. But that's not necessarily meaning it has to be so much.
What you said about the amount of money they have reminds me that it takes time and it takes resources and energy to manage a lot of stuff. And so I can kind of relate. So like if I ask for $1 million and I know exactly how I'm going to spend it, great. If I ask for $5 million and I have an idea of how to spend it, it takes a lot longer to manage $5 million than $1 million. I've like had teams that have hired more interns, and it's like, well, the interns will help. And it's like, well, yeah, but you need to manage the interns and you still need to like talk to them and report back, right? It's not like the 5 million just magically knows where to go, right? The startup founder and their team, they need to be able to deploy it properly and appropriately and strategically in a way that grows their company, right? So yeah, I could see asking for too much ends up becoming more of a burden. And then maybe you get like later on and you're like, well, we still have this $500,000, but we didn't really like put it to good use. And then you're kind of stuck. And then you're not going to be able to go back to the investor and say, well, yeah, I could use more money, because they're like, well, you just sat on that $500,000 in cash. What happened to that? Why wasn't that invested? Does that analogy make any sense?
Yeah, that's perfect. And even to continue building on that, once you get to that point where like we just sat on the $5 million, we made no progress. Even if you don't go back to your current investor, if you go to a new investor and they see you already raised $5 million, but there's no progress made, like you still have no customers and no revenue, like what's going on there. They can continue asking questions, and it'll just create more problems than kind of like the solution you were originally looking for.
Yeah, bit of a problem there. So what is the most common problem you see in a startup that's trying to scale up? What's the ceiling that they hit that that they should keep an eye out for?
So I think the biggest problem I've seen is the lack of finding product market fit. Meaning there are a lot of times when we see startups and it seems like a good idea, but it may be more of a feature and not a product. And if I could think of an example here, obviously I'll be on the top of my head. I don't want to say a real startup. So let's go. I'm interested in sports. So imagine I could go on a sports website with all the games listed, so like the scores, and the startup itself, the idea would be I can pick specific players and only get notifications from that player during this game, right? So it seems cool. It seems like a nice idea. It seems like people would use it, but it's definitely, in my opinion, from the example, it's more of a feature to for example, like a sports center or the score. So like a bigger app than a product in itself. So the main points when finding product market fit is, I think the biggest failure there is not doing enough market research, for one, and not talking to your own market. Because a lot of times there are founders who are building something for themselves, meaning they've been in the industry, which is a good thing to start with. They've been in the industry, they're building something that they've seen a problem for, but not everyone may see that problem. So talking to your potential clients, even before taking them on clients, and making sure that they're building something that's a need and not just something that's nice, is definitely the biggest problem that I've seen that kind of hinders their scaling.
Yeah, it was difficult for me to build this little podcast closet. You can't see it from the camera, but I'm literally standing in like a 2 by 5 foot closet with a really cool backdrop and really great hardware. And it was hard for me to build. But if I launch a startup that says, I'm going to solve the problem of it being hard to turn a closet into a podcast studio, the total addressable market might be somewhat limited, as popular as podcasting is, and maybe that problem just exists in my head, and I should make it a feature of another podcast production building service, or just DIY it like most people do. What inspired you to do the work that you're doing now? What problem do you see that you think needs solving, and how are you solving it in your role today?
It's a great question. I think it goes even kind of further back in my life to when I was a kid. I always loved Legos. I loved building things as a kid. And I think the idea of like putting the Legos together and building something is what made me want to become a company builder. Meaning, similar to what I mentioned before, obviously we are investors, but something that I've really learned my last years at And is before the money, what's more important to us at And is building that company. And I think that the current process in venture capital is broken. I think a lot of firms are just focused on injecting that cash and hoping for the best outcomes. Whereas we're fixing that process by being those company builders before we're investors. Meaning, I like seeing myself as a co-founder with all the companies that I see that we invest in, because as a co-founder, I want to build them. I want to help them succeed. And the more success that they have, and the more success that I can bring them, the better that we'll be together.
So that's maybe something a startup founder should keep an eye out for, is a VC firm that's not just going to write them a check, but will be a partner with them like you're doing.
Definitely. I think finding the right partner in like investors is very important. Obviously, stage does matter, because if we're talking more growth, they may need less help in like the actual building and the strategy wise, and they may just need the funding to get up to scale bigger. But when it comes to early stage companies, I think it is important to find investors that aren't just giving you that check and leaving. They're going to have a continued support throughout your whole process, if not just the beginning of your process.
Wise words. Well, Charles, thank you for sharing your expertise with me. Our listener can learn about And Ventures. I'll put a link and description of And Ventures in the description of this episode. Is there anywhere on social media you would like people to connect with you, Charles?
Yeah, feel free to connect with me on LinkedIn. Could also put it in the drop below. feel free to shoot me a message. I'm always looking to connect with founders, investors, or even anyone with an idea, just to grab a coffee in person or a virtual coffee and just discuss.
Awesome. I know a couple people who are thinking about founding startups, so I will have them buy you a virtual coffee in the near future if they decide to pursue the VC route. So thank you again for joining me today, Charles. This was a really fun conversation, and best of luck at And Ventures.
Thank you so much, and thank you for having me.
I hope you enjoyed today's episode. The Funding Blueprint is produced by me, Cody Goff, with audio and video editing by Sean Patel. If you're looking for very high quality sound design or audio video production work, then get in touch with Sean at seanpatel.com. And you can email me at cody@academicpodcasts.com if you want help turning your closet into a podcast studio. Hey, never underestimate the power of a good closet podcast studio. I hosted my award-winning podcast for Discovery from this closet. Warner Brothers Discovery. I'm dead serious about that. Not just a silly idea now, is it? Anyway, thanks again for joining me, and have a great week.